Here is something that most financial content will never admit to you. The advice you are following right now might be completely wrong. Not because it is bad advice, but because it was never written for someone at your income level. Most money tips you see online, in books, or from well-meaning friends are built around one type of person. Someone already earning well, already investing, already with a financial cushion under them. And when someone at a completely different stage tries to apply that same advice, it does not just fail to work, it can actually set them back. If you have ever read a personal finance article, tried to follow the steps, and still felt like your situation never quite fits what they are describing, that is not a you problem. That is a mismatch problem. The strategy was built for a different level, and that is exactly what this video fixes. Today we are going to walk through what your money should actually be doing at every income level in Australia. Not generic advice, not one-size-fits-all steps, the specific moves that matter most at your level right now, so you stop wasting energy on strategies that were never designed for where you actually are. By the end of this video, you will know exactly what to prioritize with your money based on your current income. You will understand why the smartest financial move at $30,000 a year is completely different from the smartest move at $130,000. And you will have a clear, simple action step you can take this week. Not someday. Not when you earn more right now. This is not about being perfect with money. It is not about sacrificing everything or becoming obsessed with spreadsheets. It is about doing the right things in the right order. Because getting that sequence right is what separates Australians who slowly build real wealth from the ones who earn well for decades and still feel financially stuck. Here is the truth about where most Australians actually are with their money. A huge number of people are earning a decent income and still living with a low-level financial anxiety that never fully goes away. They are paying their bills. They are getting by. Some of them are even saving a little, but they have this nagging sense that they should be doing more, that they are probably missing something, and they do not quite know what the right next move is. So they either do nothing, because the options feel overwhelming, or they follow advice designed for someone at a different stage, which does not move the needle the way they hoped. This channel exists for exactly those people, not the ones who already have a financial advisor and a property portfolio. The ones who are in the middle of the journey, working hard, wanting to do better, and just needing someone to cut through the noise and tell them what actually matters at their specific level. That is what we are going to do right now. But before we get into each income level, I want to plant something in your mind that we are going to come back to later in this video. Because there is one idea, one shift in how you think about money that applies at every income level and changes everything once you understand it. I will get to it. But first, let us start at the beginning. Under $50,000 a year, this is where most financial advice completely falls apart. The standard advice at this income level is usually some version of spend less and save more. And while that is technically true, it misses what actually matters. Most when your income is limited and your margin for error is thin. The number one priority at this level is not investing. It is not buying property. It is building a financial floor. Most people think an emergency fund is something you build after you have got everything else sorted. What it actually is, especially at this income level, is the single most important financial move you can make. Here is why. Without a buffer of even $1,000 or $2,000, every unexpected expense, a car repair, a medical bill, a week without work, goes straight onto a credit card or a buy now, pay later balance. And the moment that happens, you are paying 15 to 20% interest on a problem that a small savings buffer would have absorbed completely. Before anything else, build a starter emergency fund of $1,000 to $2,000. Put it in a high-interest savings account and do not touch it for anything other than a genuine emergency. That single move breaks the cycle where unexpected expenses keep dragging you back to zero. The second move at this income level that most people miss entirely is using the government incentives that are specifically designed for low-income earners in Australia. If you earn under $37,000 and you make a personal after-tax contribution to your superannuation of $1,000, the government will add up to $500 directly into your super. That is a 50% instant return. No investment in the world consistently gives you that. And yet the majority of Australians who qualify for this never claim it. There is also the low-income superannuation tax offset, which can return up to $500 in tax back into your super automatically if you earn under $37,000. These are not complicated strategies. They are free money sitting on the table that most people never pick up. The action step at this level is simple. Open a separate high-interest savings account this week and set up an automatic transfer, even $20 or $30 per pay cycle, labeled as your emergency fund. Then look up the Superco contribution on the ATO website and find out if you qualify. Those two moves, done consistently, build more foundation than any investing strategy at this stage. $50,000 to $100,000 a year. This is what I call the leverage zone. At this income level, something important has changed. You now have enough margin to make moves that actually compound. You are past pure survival. The basics are covered, and the decisions you make in this bracket will have more impact on your long-term financial position than almost anything you do later. Most people at this level think the smart move is to start buying things. A better car, a nicer apartment, upgrading their lifestyle to match their income. And the trap is that it feels completely reasonable because they can afford it. What they do not see is that lifestyle, inflation at this stage, quietly closes the window that this income level opens. Here is what the leverage zone actually means. Between $50,000 and $100,000, you have access to salary sacrifice, one of the most powerful and underused tax tools available to working Australians. By directing a portion of your pre-tax salary into your superannuation, you reduce your taxable income while building long-term wealth. Money that would have gone to the tax office is instead going into your future. For example, if you earn $80,000 and salary sacrifice $10,000 into super, you pay tax on $70,000 instead of $80,000. That $10,000 inside super is only taxed at 15% compared to the 32.5% marginal rate you would have paid on it as income. That gap is real money, and it compounds inside your super for decades. If buying a home is part of your plan, this is also the level where the First Home Super Saver scheme becomes relevant. You can contribute up to $15,000 per financial year into super, up to a total of $50,000, and then withdraw it for a first home deposit, because the contributions go in at the lower super tax rate and come out for your deposit. You effectively save faster than you would in a regular savings account, and this is the right time to start investing, even small amounts, in diversified ETFs. Pick a broad market index fund, set up an automatic monthly contribution, and leave it alone. You do not need to understand every detail of the market to start. You just need to start. Now here is the part I want you to pay close attention to, because this is where most Australians make the mistake that costs them the most. Many people assume that the key to building wealth is simply earning more, that if they could just get to 6 figures, the financial piece would fall into place. So they focus almost entirely on income growth, chasing promotions, working harder, building their career, while ignoring the structures that make income actually turn into wealth. But here is what the data on Australian households consistently shows. There are people in this country earning $140,000 a year who have less financial security than people earning $70,000. Not because the higher earner is bad with money, but because they never built the structures, the automation, the tax strategy, the investment habits at the earlier levels. And by the time they were earning well, their lifestyle had expanded to absorb everything they earned. Income is not wealth. Income that is structured, automated, and directed intentionally, that is what becomes wealth. And the time to build those structures is not later. It is now at whatever level you are currently at. $100,000 to $150,000 a year. At this level, the game shifts significantly. You are now earning enough. That tax becomes one of your biggest financial variables. And most people at this income bracket are paying more tax than they need to, not because they are doing anything wrong, but because they have not yet learned how to use the system the way it is designed to be used. The strategy here moves toward tax minimization, legally, intelligently, and specifically for your situation. Start with maximizing your work-related expense deductions. If you work from home, use a vehicle, buy equipment, pay for professional development, or have a home office, these are all potentially deductible. Most Australians at this level are not tracking these properly and are leaving real money behind every tax return. At this income level, you also cross the threshold where private health insurance stops being optional from a financial perspective. Without hospital cover, you pay the Medicare levy, surcharge, an additional 1-to-1, and 0.5% of your income in tax. For someone earning $120,000, that is between $1,200 and $1,800 per year. In most cases, a basic private hospital policy costs less than that surcharge. So not having private health insurance at this income level is actually costing you money. The other conversation that becomes relevant here is property and negative gearing. If an investment property generates rental income that is less than the costs of owning it, mortgage interest, rates, maintenance, that loss can be offset against your taxable income. At a marginal tax rate of 37 to 45%, the tax benefit of negative gearing is significantly larger than it would be at lower incomes. This does not mean property is automatically the right move, but at this income level, it becomes a strategy worth understanding properly. The action step here is to book a session with a good accountant, not just at tax time, but proactively. At 100,000 plus, the right tax strategy is worth far more than it costs. Here is the final idea, and it is the one that ties every income level together. The Australians who build real wealth are not always the highest earners. In fact, some of the most financially secure people in this country have never earned six figures. What they share is not a salary. It is a habit of doing the right thing at each level before moving to the next one. They built the emergency fund before they started investing. They cleared expensive debt before they bought property. They understood their tax position before they chased higher income. They automated their savings before lifestyle had a chance to expand. Wealth is not built in one big moment. It is built in the accumulation of level-appropriate decisions made, consistently over time. And the most dangerous financial belief in Australia right now is the idea that your current income is the problem. That if you could just earn more, everything would sort itself out. It does not sort itself out. The habits, structures, and decisions you build at your current level are exactly what follow you to the next one. Get them right now, and the next level compounds them. Get them wrong, and the next level just gives you more money to mismanage. So here's where you stand after this video. If you are earning under $50,000, your move is the financial floor, emergency fund first, then government super incentives. If you are in the 50 to 100,000 range, your move is leverage, salary sacrifice, smart super contributions, and starting to invest consistently. If you are between 100 and 150,000, your move is tax strategy, deductions, private health, and understanding negative gearing. And if you are above 150,000, your move is structure and protection, maximizing super, exploring investment bonds, automating your savings rate before lifestyle consumes it. Every level has a move. Every move builds something real. And the beauty of understanding this is that it removes the overwhelm. You do not need to do everything at once. You just need to do the right thing at your level, clearly, consistently, and without waiting for the perfect moment that never comes. Start where you are, use what you have, and trust the process of doing the right things in the right order. If this video gave you clarity on what your money should actually be doing right now, share it with someone who needs to hear it. And subscribe for more practical, no-fluff financial content built for real Australian life. There is a lot more to come.